Welcome to the TS Lombard weekly video, which covers our recent LSR view, which is all about our prospects for 2017 and our view about the year ahead. And a fairly exciting one it is, but sadly in the Chinese sense of may you live in interesting times. Specifically, the title is Bond Bear Rampant. And the point we have here is that the United States economy has been a little bit overheated ever since the end of 2014. It has now moved into faster growth again, so that it's growing at an above potential rate, and the core inflation rate is already at the target. And the actual inflation rate, the headline rate, is going to be above 2% early next year because oil prices, of course, are now up from the year before. So we're now in a situation where inflation is likely to accelerate significantly over the next year or two. And our expectation is that by early 2018, you will be seeing inflation in the 3% region. And you may well be seeing wage settlements, hourly rates, moving towards a 4% rate of increase sometime in 2018. And on that basis, we would expect by then, in spite of a strong stock market in the near term, because of the improved growth rate likely as a result of very significant fiscal easing by Mr. Trump, we would expect to see the growth of earnings being quite good for the near term, as demand pull inflation tends to give firms pricing power and therefore decent earnings, and you get good operating leverage and good capacity utilization. But in time we expect wage growth to be in excess of price growth and to squeeze profit margins, and we also expect a very substantial increase over the next couple of years in bond yields, so that what is now already a 2.4% rate for the US 10-year Treasury could be 3% by mid to late next year, and is almost certainly heading towards some number more like 4% sometime in 2018 at the top. And the only thing really stopping this very bearish trend in the US Treasury market is likely to be a rise in the dollar. And the two of those together, to some degree, trade off against one another, since the bigger the rise in the dollar, the less there will need to be an increase of treasuries, because the two of them together are going to combine to slow the economy significantly in 2018. So what we're looking at is a good old traditional boom-bust, with the boom in 2017 and the bust to be expected in 2018 or maybe 2019, but if it is postponed to 2019, then almost certainly a worse bust. So Merry Christmas, everyone.